By an expert in the labor market. He's Brendon Bernard. He's a chief economist at the Indeed.com hiring lab, and he joins us on set right now. Brendon, thanks a lot for being here. Your take from what we've heard: more jobs created in November than expected, and significantly more created than during October. So it doesn't look like a slowing Canadian labor market.
No, not slowing, but we have to remember that 25,000 isn't what it used to be. StatCan mentions the population growth was at 78,000 for the month. So in that context, things are actually lagging, and we saw that in the uptick in the unemployment rate. So overall, I think this is kind of consistent with past sort of 6 months of data showing job market continues to eke out gains, but things definitely have softened a bit from where things were.
So as you mentioned, immigration has done a really good job of keeping employment numbers really strong for the past few quarters. But do you think we've gotten to an inflection point now where continued immigration growth is all what it's going to do is just create more people entering the workforce with less jobs to fill? And so that's just going to keep ticking up the unemployment numbers?
Well, I think that on net, it's probably resulting in further job growth. That population growth does result in labor force growth. And so I don't think the impact on immigration on jobs has gone to zero. But, as the labor market has cooled down, there are fewer jobs out there. We see on Indeed, for instance, job postings were down 29% year over year. So that influx of population growth has fewer opportunities out there. And so on the margin, it's definitely going to mean less jobs per population growth. And I think we're seeing that in the employment numbers. I haven't looked today, but through October, youth employment was also down. So those are new entrants kind of struggling to find those first jobs. And I think it's just a sign of the kind of cyclical weakening of the economy. We're seeing yesterday's GDP numbers, basically flat for 2 quarters. It's kind of showing up in the employment numbers as well.
What about wage growth, Brendon? 5% wage growth ticking, remaining steady, I should say, from October. Economists had forecast, according to Bloomberg News, a modest retreat in the pace of wage growth. What does that mean, and what does it mean to the Bank of Canada and inflation?
Yeah, so this is one area where I've had to readjust my expectations, because I've kind of been looking at those job opening numbers, the sort of gradually rising unemployment rate, and expecting wage growth to cool. And now I see today's numbers, and I'm not surprised they're staying elevated, because really Canadian wages react to the cycle with just, it really seems like a substantial lag. And part of that lag, I think, is related to sort of a catch up to cost of living increases from the earlier surge in inflation, especially in areas of the economy where wages aren't going to react quickly. So for instance, in recent months, public sector wages have been accelerating, and after lagging in 2021, 2022. So they're catching up. And so I think that puts some added pressure on the overall number. And I think that's one of the factors we're seeing another wage print in the range of 5% year over year.
Does this change at all the inflation narrative, the cooling inflation narrative?
That's a good question. I think the headline inflation numbers have still been, at least last month, were in the positive direction. And inflation is so correlated, Canada and the US, that I see those two kind of like driving things, whereas the domestic labor market is kind of a secondary factor driving prices.
When you say positive direction, you mean retreating inflation?
So we had year-over-year inflation in the range of I think it was 3.1% most recently. That's a good number, bringing things down. But I think the question with the wages in the range of 4 to 5% is, can we get from, let's say, maybe 3.1 was a bit of a blip on the commodity side, but like if the underlying trend measures are in the 3.5 range, can we get that down to 2.5? And maybe that could be challenging with sort of a 5% headline wage growth. So
back to wages. I mean, we saw with the bank earnings this week that, a lot of the banks like TD, Royal, they're all, Scotia, they're all cutting their head count, right? And they're trying to reduce costs as much as possible amid a slowing economy. So do you think that there's, a link between wage growth, like stronger wage growth, and then the incentive for companies to reduce their headcount to reduce costs even further?
Well, I mean, so this is kind of like one of the interesting puzzles of macroeconomics in general, that wages, especially when the economy weakens, won't respond immediately. It's a bit of a risky move from employers to just cut wages across the board, what it does for morale, what it does for turnover. And sometimes companies will opt to lay off a portion of their staff instead of going across the board wage cuts. I do think the economic cycle is going to filter in to these wage numbers, especially when it comes to job creation. Job seekers don't have the same options for kind of finding new positions that they did 2 years ago. But the process is gradual, as we see with these still elevated numbers. And so with a bit of a mismatch in sort of how strong wages are growing compared to how strong the rest of the economy is, which is pretty lukewarm. Something's got to give. Is it that wages are going to come down, or do wages show up in higher prices, or do companies with less revenue potentially have to lay off some people?
What do we make of almost 60,000 full-time jobs being added? That sounds like something that's characteristic of a pretty robust labor market.
Yeah, and that's a positive aspect to this report. Though the flip side is, though, that the hours worked numbers were pretty weak in this report. So I wouldn't read too much into one over the other. That hours worked number is a bit concerning. One thing with the full-time jobs is that statistic is basically the LFS asking you, do you usually work more than 30 hours a week? And so if someone says yes, it's a full-time job. Doesn't necessarily mean, though, that the economy is running at full speed. If people are working less overtime, or maybe they're just above that 30 threshold, but not kind of working a full work week.
The big banks have been letting go jobs. How material is that? TD Bank, the most recent large financial institution, to say that it's going to let go a portion of its workforce.
The labor market, even in Canada, we're not the U.S., but even in Canada, the labor market is an ocean. And so one company does not drive these results. The only employer, I would say, that has the potential to drive these results is the federal government. Basically, anything else besides them, we're getting swamped in the margin of error. We know how volatile these LFS numbers are. So for any one company, it really is too small to really show up in the data.
Brendon, thank